Hi, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, up on the screen on a Thursday, mortgage-backed securities and the overall long end of the bond market having a tough time. Rates continuing to grind higher. We are now at, let's call it pre-COVID rates on the 10-year note as well as mortgages. But when you look at the chart of mortgages, you need to put that in perspective. Talking to my clients, here we are where we were, right before COVID, right? And right before COVID, the economy was doing wonderful. Well, here we are after COVID, and not only is the economy doing pretty darn good with some of the recent numbers, the ability and willingness to spend shown in retail sales and durable goods orders this week shows a lot of confidence in consumers. And that's with the economy still not even close to open. We have some big states, California, New York, that are still offline for the most part. So the better days are ahead. And that's exactly what the market is pricing. It is pricing the confidence that there will be higher prices, there will be stronger economic growth. But when you put it in perspective, see a 10-year note at 1.46, it's just not a big surprise. When you look at where we are as an economy now, what the bond market is struggling with, a couple things. The Fed is buying bonds still to well beyond what the minimum commitment they had, but it's not doing enough. And it just shows that the Fed cannot control long-term rates. Long-term rates is determined by the market forces, inflation, economic growth, and the prospects of the future. So the Fed, in our eyes, has lost the long end of the bond market. But there's an old saying, the cure for higher rates is higher rates. At some point, the yield brings back buyers. It hasn't happened yet. The 10-year note did reach just beneath 150, and 150 was a floor of support in pricing for the longest time. That would be a number to watch very closely. If we can stay below 150, there could be an opportunity for us to get a little bit of rate relief. If we move beyond 150, there's going to be another leg higher in rates. And I think what will happen over the next couple of weeks, the big story is what happens to that 1.9 trillion. Part of what the market's struggling with is that despite states doing, reopening and optimism and the pent up demand, the rising inflation, the vaccines in earnest, the COVID cases dropping, they're trying to put another 1.9 trillion. And I think the bond market's saying, hey, wait, stop it. That thing has a lot of hair on it and that's way too much paper. We don't even need it. The best stimulus that you could possibly give this country right now is to just fully reopen. So there's a lot of forces at play. Hope you're tracking it all. Have yourself a great week. We'll talk to you soon. Bye for now.